Now speaking, Alexia Quadrani, Senior Vice President, Investor Relations. I welcome everyone to the Walt Disney Company's second quarter 2023 earnings call. The press release was issued 25 minutes ago and is available on our website at www.disney.com/investors. The call is being webcast and a replay and transcript will be made available afterwards. Joining me are Bob Iger. Now speaking, Bob Iger, Chief Executive Officer. Disney had a successful quarter. Marvel Studios' Guardians of the Galaxy Volume 3 topped the global box office with $289 million. The first round of the NBA playoffs was the most watched ever across Disney networks, averaging 5 million viewers, plus 15% versus last year. ABC was the #1 entertainment broadcast network for the fourth consecutive season. Domestic parks saw increased guest experience with pricing changes and new attractions. Mickey's Toontown at Disneyland and Tron Lightcycle Run at Walt Disney World. Initiatives to reduce costs are on track to meet or exceed target of $5.5 billion. Streaming operating losses decreased this quarter. Over 40% of domestic advertising portfolio is addressable. Added 1,000 advertisers in past year, 5,000 total. Launching ad tier in Europe by end of calendar year. Higher price later this year for ad-free tier. Rationalizing content volume and spending, recalibrating investments internationally, international expansions underway at Disneyland Paris, Shanghai Disney Resort, Hong Kong Disneyland, and Tokyo Disney Resort, changes coming to Walt Disney World in 2024, unifying marketing touchpoints across businesses. Now speaking, Christine McCarthy, Senior Executive Vice President, Chief Financial Officer. Disney reported a 93-cent diluted earnings per share, excluding certain items, in the fiscal second quarter, a decrease of 15 cents compared to the prior year. There was a restructuring charge of approximately $150 million and an impairment charge of $1.5 billion to $1.8 billion is expected to be recorded in the third quarter. The media and entertainment distribution business saw a year-over-year decline in operating income and decreased domestic linear networks affiliate revenue by 2%. Direct-to-consumer operating losses improved sequentially by approximately $400 million and core international subscribers increased by close to 1 million. Parks experiences and products operating income increased by over 20% due to higher attendance and improved financial results at Shanghai Disney Resort, Disneyland Paris, and Hong Kong Disneyland Resort. For fiscal 2023, cash content spend company-wide is expected to remain roughly comparable to last year, and total capital expenditures are expected to be $5.6 billion. Now speaking, Alexia Quadrani, Senior Vice President, Investor Relations. I asked participants to limit themselves to one question so that we can accommodate as many analysts as possible during the Q&A session. Morgan Stanley analyst Ben Swinburne inquired, have you seen any evidence of customer engagement in reaction to the Disney Plus price increase that gives you confidence around pricing power for Disney Plus looking ahead? What have you learned about the potential cost rationalization and reorg opportunities at the company, and do you think there is more to be done? Bob Iger replied, we were surprised to find that the loss of subscribers due to an increase in Disney Plus's price was de minimis. To drive more subscribers to the ad-supported service, we plan to widen the delta between the ad-free and non-ad-supported services by raising prices on the ad-free and keeping the prices on the ad-supported relatively modest. We anticipate substantial growth in digital advertising in the upcoming upfront, allowing us to lean into ad-supported and increase ARPU. We are also working towards achieving cost reductions of $5.5 billion starting in 2024 and leading into 2025, with most of those coming from content spend. These strategies will help lead us to profitability and growth. Christine McCarthy replied, I have reduced our SG&A targets by $2.5 billion with great cooperation from the entire company. This includes making headcount reductions and eliminating redundancies, utilizing resources across other businesses, and utilizing technology. Some of this progress will be realized later this year, but the real impact will be seen in 2024. All business leaders have embraced this comprehensive look throughout the SG&A buckets. Bob Iger replied, I launched Disney Plus in numerous markets, including those with low average revenue per user, ARPU. I spent money on marketing and local content for these markets. As we move towards profitability, I am looking into opportunities to reduce expenses in markets where the revenue potential is low. Alexia Quadrani replied, I received a question from Phil Cusick of JP Morgan on date. JP Morgan Chase & Company analyst Phil Cusick inquired, can the contribution from Shanghai be analyzed relative to pre-COVID and its potential? How should investors think about the risks associated with the political issue in Florida, both in the near and long term, for Disney? Bob Iger replied, at Shanghai, the business is doing extremely well on both attendance and per cap basis. The park will have new attraction Zootopia coming later this year. Regarding Florida, Disney filed a case stating it is retaliating against them for taking a position about pending legislation. There are 2,000 special districts in Florida and Disney pays $1.1 billion in state and local taxes annually. Disney plans to invest $17 billion over the next 10 years and pays employees substantially above the minimum wage set by the state of Florida. Alexia Quadrini replied, I received a question from Michael Nathanson of MoffettNathanson on date. The MoffettNathanson analyst Michael Nathanson inquired, do you think the slowdown in DTC content spending will have an effect on global subscriber growth, and how does the move to one app in the US offer a solution? What can we expect for future cash content spending? Is this year the peak year, or will we see declines? Bob Iger replied, we launched the service 3.5 years ago and initially focused on creating as much content as possible to drive global subs. However, we now understand that some of this content is not contributing to our bottom line, so we are taking a surgical approach to reducing content spend without impacting subs. We are focusing more on real sub drivers, such as films released theatrically, and allocating more money to marketing these films. This is part of the maturation process of learning what consumers want from our service. Christine McCarthy replied, Bob is working to save $3 billion annually on content spend, with the sports component accounting for over 30% due to contract rate increases. For fiscal 23, our estimated content spend is roughly comparable to last year's figure of $30 billion, but this does not account for any potential impacts from the writer's strike. We are looking to reduce volume of content and taking a more curated approach to Disney-branded and general entertainment content. Alexia Quadrini replied, I answered a question from Jessica Reif-Ehrlich of Bank of America Securities. Bank of America Merrill Lynch analyst Jessica Ehrlich inquired, have you updated your thoughts on ESPN and its transition to ESPN Plus in light of the accelerating decline of the pay TV universe? Is this enough to offset linear losses and start to drive growth? Bob Iger replied, I have been addressing ESPN's position on migrating its flagship service to a direct-to-consumer or streaming platform and the impact it has on linear channels. We predicted that linear networks would experience subscription and advertising declines in 2015 to 2016, which is why we got into the streaming business. To turn the streaming business into a profitable growth business, we are making organizational changes and cost reductions, marketing changes, programming changes and investing in technology to serve advertisers digitally. We are also bullish about Disney Plus and Hulu combined and leaning into digital advertising. Alexia Quadrini replied, I was asked a question by Kannan Venkateshwar of Barclays on date. The question. Barclays analyst Kannan Venkateshwar inquired, have the plans for combining Hulu and Disney Plus allowed you to change its cost structure, such as reducing content spending or the number of titles offered, and raising its price? Can you provide some insight into how the recent wage increases in Florida will impact the revenue and EBITDA growth of your parks business? Bob Iger replied, we have a contractual arrangement with Comcast that enables us to take their share of Hulu back in early 2024. We are exploring ways to grow our streaming business and believe combining Disney Plus content with general entertainment will be beneficial for subscribers, advertisers, and the company as a whole. We've had cordial conversations with Comcast and are hopeful that Hulu is the ultimate solution. Christine McCarthy replied, overall, we expect solid earnings growth in domestic parks for the year. However, increased costs related to wages, due to a new union contract and inflationary trends, new guest offerings and operational support for an additional cruise ship may cause margin pressures. The team is leveraging tactics to mitigate potential risks and increase capacity with newer attractions and IP to meet customer needs. The cruise business has come back strongly and is expected to continue throughout the fiscal year. Alexia Quadrini replied, I received a question from Michael Morris of Guggenheim on August 5, 2020. Guggenheim Partners analyst Michael Morris inquired, can you share any early details on Disney Plus with advertising product and what impact do you believe artificial intelligence will have on the business over time? Bob Iger replied, Mike is looking forward to a future where artificial intelligence, AI, could replace him on earnings calls. He believes the AI may even provide better results than he can. Bob Iger replied, AI developments offer significant benefits to us, such as creating efficiencies and improving customer service. The potential for disruption is high, however, especially from an IP management perspective. Our legal team is working hard to address the challenges of AI, which is a problem faced by many industries. Despite these challenges, I remain optimistic because of the potential to provide better services to customers. Christine McCarthy replied, "We launched Disney Plus in December 2019, offering a lighter ad load than Hulu. Despite the challenging macroeconomic advertising market, we are seeing existing and new sign-ups for our ad tier. We have invested in our ad tier technology and data platforms to provide state-of-the-art programmatic and addressable ad tools. We will launch the ad tier on Disney Plus in Europe by the end of this calendar year." Alexia Quadrini replied, "I took one last question from Doug Mitchelson of Credit Suisse." Credit Suisse analyst Doug Mitchelson inquired, "Do you still believe that having multiple services to give consumers choice is the right approach? If so, do you see Disney Plus becoming a platform to broaden the number of subscriptions and monetization opportunities while maintaining a premium experience for consumers? Is fiscal 3Q the peak for streaming losses?" Bob Iger replied, "We announced an integrated app experience today for consumers who subscribe to both services. The dual bundle is combined into one experience, making it easier for users and providing more content than before." Outside the US, Star is a successful advertiser-supported platform which offers significant amount of programming. This app will provide quality curated general entertainment, helping to grow advertising, subscriber fees, engagement, reduce churn and costs. Christine McCarthy replied, "I reported peak direct-to-consumer losses of $400 million in Q4 '22, followed by a $400 million improvement in Q1 and Q2. Q3 will widen out by $100 million due to release and marketing timing, but this is an aberration and we expect to continue improving from the peak for the rest of fiscal 23. Alexia Quadrini replied, "Today, we thanked everyone for joining our call. We provided a reconciliation of non-GAAP measures to equivalent GAAP measures on our investor relations website and reminded participants that certain statements may be forward-looking. We noted that these statements are based on our views and assumptions regarding future events and business performance and are subject to risks and uncertainties. Finally, we thanked everyone for joining us and wished everyone a good rest of the day."